Welcome to Cycles TV. This session of the Market Cycles Report is intended exclusively to provide information and education to help individuals better understand cycles and the markets. However, this information is not to be construed as professional advice as to the buying and selling of securities. In no event does the host express any opinion with respect to, or make recommendations regarding, the purchase or sale of any particular investment instrument. There is a very high degree of risk involved in trading. Buying or selling decisions are solely within the personal discretion of each individual. And now, enjoy the show. Here is your host.
Welcome to the Foundation for the Study of Cycles. My name is Lars von Thienen. Welcome to this weekly episode of Cycles TV. We are here to do education on cycle analysis using global financial markets. Have you seen the session last week with Peter? What an amazing session. And I hope you have visited the price targets we have given last week, Monday. It's always fascinating to see different approaches on cycle analysis coming together. So if you have not seen, please review last week's session with Peter. We discussed price cycle projections in addition with time cycle projections. So I'm still honored by having Peter here on the show. So what's up today? Today I have a special topic prepared. We are live and I will also review your questions at the end. Today we will talk about new home sales. It's a data set which is published as monthly series in the US. And the question I want to discuss with you today, and I want to show you some cycle analysis. Can this be used for timing US recessions? So the purpose of cycle analysis, we want to get a clue what might happen in the future in regards to a possible timing indication. We've talked a lot of times in the last weeks here how to judge the global financial markets. And I think it's more or less common sense that we're heading into recession. There's more to come. We're not talking about short-term movements here. So let's now focus on a longer-term picture. Let's find additional data sets which we can use in combination with the raw market data. So just a quick information, new home sales is also some data, also known as new residential sales information. It is used as an economic indicator. It's published, it's more or less open source by the US Census Bureau, and it measures the sales of newly built homes in the US. And often the new home sales is also closely watched by investors, financial analysts to get clue about the broader economy. So, and for us as cycle analysts, it's very interesting, and this is often important what I try to explain and teach here, not just analyzing the raw core data like the Dow Jones, the S&P 500, that's more the current price. What's always important for a cycle analyst to find data sets which are not directly correlated, but indirectly or loosely correlated with the economy, and therefore leading or lagging indicators to the raw data set we are at the end maybe trading or investing in, or what we want to get a clue when maybe a top or a bottom might occur from a timing perspective. But in most cases, there are often more interesting leading indicators than the raw data set itself. So therefore, new home sales is another data set we can have, and we can also judge it as a kind of sentiment of the global economy. I mean, if we have a very positive outlook in the economy, the new home sales will rise. And if in turn the economy gets a very bad recession or bad mood, then for sure private people will not sell or even buy new homes. It's kind of more or less common sense. And if we can measure new home sales, we can also kind of measure this sentiment. And sentiment is a very good data set for cyclic behavior. So that's the purpose. This data is freely available. Put it into our cycle analyzer and you can analyze these cycles on your own. It's a monthly data set. So that's the purpose for today, for the next 20 minutes. And I can be sure there will be an interesting outcome at the end. So first, let's jump into the studio and the data set itself. This is the new home sales data set published by the US Census Bureau, just using the FRED API or the Public Reserve of St. Louis database to just show the raw data set in general. So this is the data set going back to 1960, monthly data points. So we are then dealing about very long-term cycles here in this data set. And you see that we have a large drop and we have an up move into the year of 2020 and dropping since then. And that's where we are today. Current reading. So this raw data set is available. I've uploaded this into our cycle analyzer. But before I want to analyze the cycles here with you, let's have a quick view on the gray highlighted areas in time here, because these are the important points in time we need to understand first. So these periods of time highlighted in gray here, so here at this point where my cursor is, here and so forth, these are also indicated at the bottom of the chart, the so-called US recessions. So these are being points in time which have been taken into account as official US recessions here. So these gray periods in time are not related to this raw data set. You will see the same timing of the US recessions. You can pull up and I think I have another chart here. No, but it's not related. That's what I mean. And these gray points in time are the so-called periods with the US in a recession. And what's interesting here by this data set, you can see that by bottoming of the new home sales, it's always then the end of these recessions here, or the bottoming of this data series is a very clear indication, first, that we are in a recession, and second, the bottoming of this data set indicates the end of the recession here, as you can clearly see by this period. So while this gray data is not related to this raw data set, this is more or less general information on the US recessions, it might be interesting for you to understand these data. So because these periods in time are officially nominated after the fact. So anyhow, it's not predictive, but the National Bureau of Economic Research is publishing this so-called US business cycle expansions and contractions. And the so-called here, the contractions, are the periods of recession. So there's a committee. So there are some experts here sitting on this committee, and they are looking at different financial measures. And if these financial measures are peaking and going down, they call this now a contraction, recession, and the other way around. So it's not digital signal processing. This committee is looking at financial data sets, and then after the fact, nominates these peaks or points in time, which are published here. And the last official date is February 2020, where the peak occurred as an last key point. But we anyhow need to wait. So the new data comes in very lagging, because this is always after the fact. But the question I want to answer with you is to first understand what this gray period is. I would recommend research a little bit what this is doing here, because this is also related to cycle analysis. So you should be aware of what the National Bureau of Economic Research is doing, what they are publishing here. But that's not the core point. This is just explaining where these gray points in time come from. But the listing of these gray periods is after the fact. Wouldn't it be interesting to predict when the next recession might be bottoming? I mean, that's where we are. That's now when it gets interesting, not nominating after the fact peaks and bottoms. That's more or less an easy job, or we can leave it to the committee rating these points in time long after the fact. If we can use cycles now to predict these possible US recessions, that's what we're looking for. So I mean, I think cycles told us anyhow end of last year that we're at the edge of running into a recession, and we explained during the last weeks that cycles even stack up to that. So now it's interesting, do we find measures or additional cycles which could give us clues in past recessions? And maybe, I mean, we don't know if a recession is around the corner, but if so, maybe we can use then this cyclic model, if we find it, to show when this recession might end. And therefore, to answer this question, I want to use this data set. So new home sales, this is the blue line here, overlaid with the gray points in time around the business cycle. We have a bot here in the chat section. My God, I need to just throw out these bots here. It's a pain. What are you doing here? Give me a second. I need to stop this. I can't manage this in parallel here. These nasty bots. I want to get rid of them. Yeah. Okay. So I hope this bot has now gone. So sorry for that. Okay. Whatever you like. So that's, sorry for the interruption. So I think that was just the intro and explanation on that. I hope I stopped this spam because I want to have a live discussion with you real people here, and I don't want to discuss with bots here. But I think this one has been now kicked out. Okay, back to the topic here. So new home sales. Please do your research why new home sales might be interesting. Second, US recessions, gray areas in time, explained when there are. Third, we need to find a way to predict the next US recession and the possible point in time when the recession might come to an end. So therefore, let's now do some cycle analysis on the new home sales data set. So therefore, we jump into our cycle analyzer. You're going on my nerves here. Okay. So I have uploaded this data on my own. This is a preview on the new data set you will see anyhow. So I will now search for, I think I named it US new home sales. So you can search in the data sets, which will become more easy for you in the future. So here now you see the same data set, which I've shown you in the Fred data series, loaded now into our cycle scanner. And we see the spectrum here at the bottom to do now our basic cycle research here with this data set. So we see, to explain this first here, we are looking for these clear peaks in the spectrum. So this one with the length of 83 months, always be careful here. We're talking about monthly series here, 83 months, which is this peak here in the spectrum. So we can activate this cycle here just by clicking on the cycle here. So now this is overlaid in the top chart here. This is the more or less, there are shorter cycle, but I would count this as the maybe shortest cycle to go with. And then the next one, which might look interesting, has a length of 103 months, which is now also activated. And then the third one, I mean, we need to be careful here as the separation to the right is not as perfect as we would like to look for it, but we can use this one here with a length of 180 months, a very long-term cycle. So this cycle model using just 3 cycles is plotted now on top of this list here. You could add this here also to the mix with the 64 cycles, which would make it a little bit more interesting, and then the longer term one here. So let's get to these 5 cycles here. So this is a pure cyclic model using the top 5 cycles. I've just not used the 16-month cycle because this is a very, very short cycle. You will see if I enable or disable this short-term cycle, the key turns in this data set will not change at all. So you can skip the second one here. So let's use the first top 5 cycles which have been detected by the cycle scanner. So that's the first point to keep in mind. So we are not using a special procedure here, just from top to bottom using the top 5 cycles maximum. I would never use more than 5 cycles in a composite to use, maybe 3, but I think I've shown you the 3 and maybe go up to 5. So now we need to analyze the overlay of the composite cycle model and the raw data set first. So we can now phase out the spectrum and the list, just make it a little bit larger. So this is now the new home sales overlaid by the composite cycle model we have just built here. And you see it fits nicely from the raw data set. Yeah? So the key turning points here in the past are nicely aligned. That's always the first point to look for, that these tops in the composite model are aligned closely with the key turns in the raw data set. I think I don't need to highlight that. That's more or less obvious here. So here's the low in the real data set. So we are not talking about price alignment here. We're talking about timing alignment. Yeah. So even though it looks like the price prediction is okay, but that's not what we're looking for. We're looking for the points in time here. So yeah, that's pretty clear. Okay, so enough with that. And now, as we can see that we have a very high correlation, even the correlation score is around 0.8. So a very high correlation between this composite cycle model, just using 5 cycles, five cycles. And now let's look at the projection area, which is here on the right. Let's even zoom in. So the next low of the new home sales might be projected for the year of 2024, let's say summer 2024. So we have more or less 1.5 years, up to 2 years still to come for the new home sales to decline into a period where the recession, or if there is then now showing up a recession, when the recession might end in the summer or early 2024. That's what the cyclic model here predicts. And that's now interesting because I want to go back now to this gray recession area. So I've not talked about that. So let's closely look at when this composite cycle model is forming the bottoms here in this chart. Yeah, and I will now give them numbers to show you even more what these numbers mean. So here is the first bottom. You can clearly see which is around between these two lows here, which is 9069 somewhere here. So let's mark this point number 1. Yeah, point number 1. 9069. So point number 2, we're counting the lows here, which is at this point in time here. So where is where this is at 9074. Yeah, so this is point number 2. Let's give it here point number 2, which is this second low here, point number 2. So point number 3 comes in here at around 1982. So here's 1982. So here, this low, let's give it number 3, 1982. So let's now go forward. Here is the low at here. That's the fourth low of this composite here, which is around 1991. Yeah, so here's 1990, 1991. So this is point number 4. Bottom number 4 of this composite cycle. So I will skip this for a moment here, but I will explain later. Let's move forward. So if we call this number 5, here is number 6, the bottom of this composite cycle here, where we have the turn. If you go down to the time axis, this is point number, let's give it point number 6, which is 2001. Yeah, it's close to 2001. So then the next bottoming point is around here, 2009, which is here. Let's call it point number 7, which is 2009. And then the next to come is here. We could discuss this one here. It's maybe 8, but the next clearer one is then here. This is the future, where I told you this is point number 8. What we're looking to into the future, 2024. So, but now let's have a closer look at these points. 1, 2, 3, 4, skip 5, 6, 7. These are the bottoming periods of the composite cycle. Clearly aligned. I think this message is clear here. Let's now switch to the raw data set just with the gray areas, but you could use any overlay here. You could use the Dow Jones. The gray points in time would not change. And let's now count the same numbers. And you might need to switch forth and back, but I will explain you. This, wait a second, I need to organize myself. So here we have, this is 9070, 9069, 9070. This was point number 1 on the composite here. So point number 2 was 1975 on the composite. Same timing here. So point number 3, we can also switch forth and back. Give me a chance. So point number 3 here was the year of 90. It's very small here. I need to make it bigger that I can see it on my own. Here, where we have it here, it's 90, 80, 83, 82. Yeah, 1982. So let's go back to the other chart here. That's 1982. It's exactly here where we had this recession. So let's now look for the next bottoming point, which is now seen here as point number 1991. Yeah, point number 4, 1991. Going back to this one here, 1991. Point number 4 of the bottom of the composite. So the next one, I tried to explain you. We skip this one here. So then point number 6 is at this one here, the year of 2001. Let's switch back to this chart here, the year of 2001. Point number 6 of the composite. Same procedure. Let's go back to our composite chart. Here's point number 7. So the next bottom of the composite cycle, it's the year of 2009. Switching back to this data set, 2009. Point number 7. So, and that's now, I hope you got the point here. So the composite cycle model from the new home sales data series was able to form a bottom exactly at the points in time where in history recessions have been officially labeled at the point in time. And at this point in time also the recession has come to an end. So that's a composite model found on new home sales, not on the stock market, not on the USD yield, on the new home sales. This composite model here the bottoms of this composite model is exactly in alignment, in correlation with past US recessions going back for the next 50 years. Now, the predictive value comes as we can plot this composite cycle into the future. And that's now, if this composite and the correlation of this composite continues, the next bottom for this composite is projected to show up in the year of 2024. So early to summer 2024. That's point number 8, which will be point number 8 here, somewhere in the future, maybe marking the next US recession, which will come to an end summer 2024. Got it? Okay, so yeah, here you have it. Another data set, applied cycle analysis, basic approach how to pick the cycles, going over key turns of the cyclic model, checking if they are correlated to important points in time in the global financial markets. I explained to you that these bottoms are exactly at these points in time of US recessions and the end of these recessions. And that's the beauty of cycle analysis, plotting this model into the future. Then looking for the next key turn of the bottoming here, which we're currently looking for, which will give us an hint. I mean, it's not set in stone that it will happen that way. But, and to be honest, the outlook for next year is not good looking at this projection here, but it could give us a sense what to expect next year. And if we want to get a clue out of it, I think 2024 will be the year where everything gets better now. At least you're looking at this cycle model here. That's it for today. I think this was the key topic I wanted to share with you today. And I think first, I think it gives you a lot of ideas to do your own research, yeah, on new home sales, the public data set. I showed you the National Bureau of Economics tagging US recessions in the cyclic data set after the fact, using this data set for cycle analysis, picking the key cycles which are important and doing a projection. So this is what we are doing here every week. This is what I want to explain, teach, give you additional knowledge how to use it, that you get a clue how to apply cycle analysis, how to even get better in cycle analysis, to find your own ways for that. So that's it for today. I will have now a quick look at your questions in the chat sections, and excuse that we had this spamming bot here in the sessions. Pez, can you please copy the link to those data? Yes, I will update the link in the video description just after the session. I think I posted the one to the Fred data series already, but I can post also the links to the US business cycle expansion contractions and the US Bureau of Consensus to find this data. I will update the description for sure. Just related to some individual data sets. So Tesla, the latest split from August is not in the data set. Yes, that's the point. We need to reset our internal caching routines as we are just using this financial data from other public available institutions, and we cache some data. Therefore, we need to reset it. What you can do is you have the bug report button in the application. Let me quickly show you where you can give us a hint. I mean, in the new user interface, it will look here, and then you have the report bug. Yeah, it's not a bug, but there you can then report a data set bug to us. I think the bug report might be located in the older version at a different place, but that's where you can give us a hint about that we need to update this information here in the cycle application, and then we will look to refresh this data set. Okay. Yeah, that's a very good question. Anyhow, I'm not able to answer it in a short way. The recession timing, similar to Europe, that would be now the next step. I mean, the data used was for the US, and I think due to the current economic conditions in the US and Europe, which are quite different to the energy crisis we have here in Europe, which might be not the same in the US, I think we will see a diverged situation in the US and Europe. So we should look out for similar data sets for Europe. So new home sales in Europe, doing the same analysis. I've not done this, but Ernie, this would be the way to go. Let's look out for a similar data set in Europe and do the same analysis. And then let's see if we find different points in time. Okay, another question here. In one of the last S&P 500 discussions, you indicated a recovery could start in the middle of 2023. That would be a year ahead of the end of the recession. Yes, that's correct. The long-term cycles, just doing the standard procedure on the S&P weekly data set, suggests that the long-term cycle might bottom in the year of 2023. So we need to fine-tune this beginning next year. So somewhere between middle 2023 and maybe early 2024, the recession will come to an end. And maybe we might, the stock market might still move upwards while the recession has not finally ended. So the stock market might be ahead of anticipating that the recession might come to an end. But that's fine-tuning timing. Beginning of 2023, we need to update the longer-term cycles on the raw stock market. I mean, the timing could change, and then have a look for when the recession timing comes to an end, what might happen between mid-2023 and early 2024. And we also need to bring into account technical indicators. But from a long-term perspective, that would be the window, second half of 2023, maybe first half 2024 to fine-tune. But as said, we need to update this beginning next year. I think it would not make sense to fine-tune now. We need to wait until early 2023 will arrive to update this cycle. Okay. Yeah, when I would have the answer, I think that's the point now. The housing market and new sales, there's happening a lot of topics. The mortgage rates and the yields are changing. So I think it's a very complicated and a changing environment now for the housing markets in general. So I can't give you the answer, but you could use cycles to fine-tune your timing here. And I think we will see lower house prices, not so much new home sales, which will impact in turn the sales price, the mortgage prices. But I'm not the expert for housing markets, so I can't do any expert advice here. Okay, in this question, the cycle scanner is running with hourly data. Is it also possible with minutes? Yeah, sure. So the cycle scanner can take any data series. To be honest, the digital signal processing does not know what is the distance in time between each data point. It could be seconds, hours, days, weeks. So the method works on any length of data series. you just need to understand what you're doing and how to interpret the data. So in general, we provide daily data to make it easy, and the noise in daily series is not as high as if you go down to lower time frame as hourly or minute data. So you need to be more and more an expert, to say it this way, in the output of the spectrum, and to decide which cycles to use for a projection if you switch to intraday, like hour or minute data, because there's more noise. If you use these lower time frames, more noise means more cycles will be detected in the spectrum. So it's up to the analyst to decide which cycles to pick for a projection. And this is what is more or less the experience you need then if you move down to lower cycle analysis periods. So this now gets, if you now combine different data sets. So I mean, if we can predict even a lagging indicator, I think that's maybe it sounds strange, but if we can predict lagging indicators which are expected to bottom in 2024, and Dale, we had the discussion up front, so your point is correct that we predicted the stock markets maybe to bottom in 2023, and stock markets are leading indicators, so this comes into alignment. So that somewhere in mid-2023 or late 2023, as the stock market cycles suggest, we can see in the bottom in the stock markets, and the lagging indicator as new home sales then just bottoms in early 2024. So then everything might fit together again. So that's a very good point. And that's why you always need to have more background in the data series you're analyzing. And I would leave it up to you, as I'm not an expert in each individual data series. Just want to outline how to use cycles in this data series. Yeah, so I think that's it for today. And that's more or less on your key questions for today. Yes, I mean, we could run for hours to come. So there's land prices versus property prices. And I think this triggered the discussion I want to like you to continue on your own. I mean, the cycle scanner is there for every member. Upload these data series, analyze the cycles, and then what you suggest here, you can do your projections on these different data sets and correlate these to leading, lagging, correlated indicators like the stock market. So I think you got it for today. Thanks for joining me again. Please like this channel, subscribe to the channel, recommend us to your friends. We want to grow our community, and I would like to see you here again next week, Monday, same time, same place. Let's do cycle work. Have a nice week, stay safe, and we will see you together next week, Monday. Bye.